Entering the world of cryptocurrency can be both thrilling and overwhelming. The idea of making quick profits, participating in the decentralized financial revolution, or being part of cutting-edge technology attracts millions of new investors every year. But with excitement comes risk, and the crypto market is notoriously unpredictable. Every day, thousands of newcomers buy crypto for the first time, dreaming of fast wealth, only to fall into common pitfalls that could have been avoided with proper knowledge. Understanding these mistakes before you invest is crucial for protecting your capital and building long-term success. In this video, we'll explore the top 5 mistakes new crypto investors make and provide practical strategies to avoid them. From impulsive buying and FOMO to ignoring research and risk management, these errors can cost you not just money, but also confidence in the market. Crypto moves fast, and decisions made without careful planning can lead to costly consequences. By learning from the errors of others, you can avoid unnecessary losses, build a smarter investment approach, and grow your portfolio with confidence. Whether you're investing in Bitcoin, Ethereum, altcoins, or decentralized finance projects, understanding these pitfalls is essential. We'll dive deep into each mistake, explain why they happen, and show you how to make smarter, safer decisions in 2025. Crypto is full of opportunity, but success isn't about luck, it's about preparation, strategy, and informed decision-making. Grab a notebook, pay close attention, and let's uncover the top mistakes new crypto investors make and how to avoid them. By the end of this video, you'll be ready to invest with intelligence, discipline, and confidence. The crypto market can be daunting, but with knowledge, you can turn potential risks into opportunities. Let's get started. Mistake 1. Investing without proper research. One of the most common and costly mistakes new crypto investors make is jumping into a project without doing proper research. Many people buy coins based on hype, social media trends, or advice from friends without understanding the fundamentals behind the cryptocurrency. Research involves analyzing several critical factors: the technology behind the coin, the project's roadmap, the credibility of the team, market demand, and long-term potential. Neglecting research can lead to investing in scams, unstable projects, or coins with no real-world value. For example, during 2021, many low-quality altcoins surged in price due to hype, only to collapse shortly afterward, leaving uninformed investors with significant losses. Proper research allows investors to identify strong projects that have a chance for sustainable growth. Tools like white papers, project audits, on-chain analytics, and community engagement can help evaluate legitimacy. Understanding a project's goals, use cases, and adoption potential is crucial. Even experienced investors spend hours researching before committing funds. Successful investing isn't about following trends blindly. It's about gathering information, analyzing data, and making calculated decisions. Skipping this step is like gambling with your money. By investing in knowledge first, you set yourself up for long-term success and avoid costly mistakes. Mistake 2. Giving in to FOMO, fear of missing out. FOMO, or the fear of missing out, is another trap that snags new crypto investors. It occurs when investors make impulsive decisions because they see others making huge profits or hear about coins skyrocketing in price. FOMO can lead to buying at the peak of a market rally and selling in panic during a correction. This behavior often ignores fundamental analysis, risk management, or timing. Social media amplifies FOMO, with influencers, crypto communities, and trending hashtags creating pressure to act quickly. Stories of overnight millionaires can make new investors chase opportunities without understanding the risks involved. Successful investors resist the urge to act impulsively, setting clear entry points and maintaining discipline. Tools like dollar-cost averaging, stop-loss orders, and pre-planned investment strategies can help mitigate the effects of FOMO. Learning to control emotions is key to avoiding this mistake. Instead of chasing hype, investors should focus on long-term value and data-driven decisions. By managing FOMO, you protect your portfolio and make rational choices, which is far more important than chasing short-term gains. Mistake 3. Poor risk management. Poor risk management is one of the leading reasons new crypto investors lose money. Crypto is highly volatile, and even established coins like Bitcoin and Ethereum can experience price swings of 10 to 20% or more in a single day. Many investors fail because they put too much of their capital into one asset or use leverage irresponsibly. Margin trading can magnify gains, but it also amplifies losses, sometimes wiping out entire accounts. Diversification is a critical strategy to manage risk. By spreading investments across multiple cryptocurrencies, stablecoins, or even traditional assets, investors reduce exposure to a single market event. Setting realistic goals, implementing position sizing, and preparing for volatility are essential. Many new investors overestimate their risk tolerance and panic during market dips, making emotional decisions. Smart risk management is not only about protecting capital but also about creating opportunities for steady, sustainable growth. Investors should always plan for worst-case scenarios, use stop losses, and avoid chasing profits recklessly. Understanding risk management is a skill that separates successful investors from those who consistently lose money. By controlling risk, you stay in the game long enough to capitalize on growth opportunities. Mistake 4. Falling for scams and fraudulent projects. The crypto world, while revolutionary, has a dark side filled with scams and fraudulent projects. Ponzi schemes, fake token launches, phishing scams, and impersonation of legitimate projects target inexperienced investors every day. New investors often fall victim because they trust blindly or fail to verify sources. Always check official websites, social media accounts, audits, and community feedback before investing. Avoid projects that promise guaranteed returns or sound too good to be true. Reputable projects are transparent, have verifiable teams, clear use cases, and active communities. Scams can result in complete financial loss and erode trust and confidence. Educating yourself about common scams, using secure wallets, enabling two-factor authentication, and avoiding unverified links can protect your assets. Creating a personal checklist for evaluating projects before investing is a smart habit. The crypto market is exciting, but without caution, it can be dangerous. Awareness and vigilance are the first steps in protecting your hard-earned money. Every investor should treat security and verification as an ongoing priority. Mistake 5. Ignoring long-term strategy. Many new crypto investors focus solely on short-term gains, chasing hype or day trading coins, and neglect the importance of a long-term strategy. Crypto markets are highly volatile, and reacting emotionally to every price swing can lead to significant losses. A long-term strategy includes setting clear financial goals, determining investment horizons, evaluating risk, and tracking performance over time. Combining short-term trading with long-term holding of strong assets balances risk and opportunity. Investors without a strategy often buy and sell impulsively, which leads to inconsistent returns and frustration. A disciplined approach helps navigate market turbulence and builds wealth sustainably. Long-term planning also allows for portfolio diversification, rebalancing, and growth aligned with your financial objectives. The most successful investors view crypto as a long-term investment rather than a gamble. Patience, research, and consistency are your best allies in a volatile market. A well-thought-out strategy ensures that market fluctuations don't derail your financial journey. Avoiding these top 5 mistakes is the foundation for success in the crypto world. Investing without research, giving in to FOMO, ignoring risk management, falling for scams, and neglecting long-term strategies can be costly, but they are avoidable. By learning from these common errors, you can protect your capital, grow your portfolio, and gain confidence in your investment decisions. Remember, crypto rewards patience, knowledge, and strategy, not impulsive behavior. Take the time to research, plan, and invest wisely. Monitor your investments, track market trends, and always prioritize security. By approaching crypto with discipline, you can turn potential risks into profitable opportunities. If you found this video valuable, make sure to hit the like button to support our channel. Don't forget to subscribe for more insights, tips, and strategies for new and experienced crypto investors. Share this video with friends who are entering the crypto space and want to avoid costly mistakes. Stay informed, stay cautious, and build your wealth intelligently. Success in crypto isn't about luck, it's about informed decisions, strategic planning, and patience. We'll see you in the next video with more tips to thrive in the world of cryptocurrency. The future of finance is here, and understanding these lessons is your key to navigating it successfully.